Welcome back. Time to unpack what that interest rate decision means for you and I. And quite interesting to note there, as the Reserve Bank Governor was delivering that statement, the rand sitting at 15.89 as he made that announcement, and of course taking those journalist questions, rand at 15.79, and it's quite an interesting improvement given that this morning when we started trading 16.05, so 0.3%, a little bit firmer, and this was in the lead up to that interest rate decision. But to talk to us and unpack it further, we are joined by Chief Economist at Nedbank, Nikki Weimer, and we also have Peter Bauer, who is an economics professor at the University of Johannesburg. Nikki, I'm going to start off with you. Were you sitting in the camp that expected a 50 basis point hike?
Yes, we were, fortunately. But yeah, no, we thought as much would happen. I think there are a couple of things that is clear, is that globally we're sitting with a very unfavorable environment. We've got growing evidence of a loss of global growth momentum, at the same time extremely elevated inflation. And as a result of that, we now have the US Federal Reserve. If you think about it, their decisions around interest rates really set the risk-free rate, regardless of what particular asset you're looking at, and they decided to move at a faster pace, indicating that they moved to a 50 in May, and the general expectation is that they'll move with another 50 at the next meeting. Definitely, I think the market they put about over an 80% probability on that, and there's even a likelihood that they might increase with another 50 thereafter, and then with 25 every single meeting from there on, which would take their interest rates up to around 2.7%. And in that sort of environment, you would anticipate the rand would start to feel the pressure. And we've already seen the rand is very volatile, very sensitive to the news flow coming out. And so against that context, plus high oil prices, plus high food prices, we just thought, as far as the Reserve Bank's concerned, the incentive is there to move a little bit faster.
Peter, I'm going to come to you with this one, because in the run-up, like probably the past few days or so, as you were digesting different commentators talking about, or at least trying to speculate in which direction the SARB would go, whether it's 50 basis points or 25 basis points, we then get, a message there from the Reserve Bank Governor saying that 4 of the committee members preferred the 50 basis points and 1 of them preferred 25 basis points. And perhaps you can talk to us about what the impact would have been had we gone the 25 basis point hike.
Well, to start off with, I definitely would have been one who would have gone for the 25 basis points. Our challenge in the moment is economic growth. We're sitting with a very high unemployment rate right now, and businesses are struggling as it is. Yes, we do see the global markets obviously being very volatile in the moment. We're also seeing sort of, shall we say, huge pressure on supply side in terms of oil prices, and of course the Ukraine conflict is not helping with commodity prices either. So the thing is, when we look at home within South Africa, we really need to be consider what kind of growth objective we want to try and achieve, and this kind of interest rate hike is very severe, very harsh. We did expect an increase in interest rates, but the steeper these interest rates are, the more curtails our growth. Yes, we are stabilizing, going a long way to stabilizing the rand, but this is a big concern for us on a socio-economic level.
On that note then, Nikki, I mean, your comments on that one, because when the Reserve Bank Governor was trying to unpack the rationale of that 50 basis point hike, he mentioned that he doesn't see their stance as aggressive, the move from 25 to 50 basis points. Was it an aggressive move at this point?
Well, I think the point that they're making is we're coming off such a low base. Remember, we cut interest rates to, what was it, almost a 55-year low just after the pandemic. So we're coming off a very low level. Interest rates are extremely low. And so in a way, at this point, remember, we just started hiking interest rates in November last year. We're actually normalizing. It's not if you look at all indicators of whether you have now gone into that position where interest rates are at such a level that it starts to constrain economic growth, we're not there yet, and we're quite far from that level. So that is, I think, what he means when he refers to underlying monetary policy still being accommodative. That is what he's referring to. I think the other thing to bear in mind is I really do not think that interest rates is the reason South Africa is not growing. And that is where I have quite a big disagreement with that argument. I think the key reason we're not growing is that we have significant infrastructure constraints, and the biggest one of that obviously being electricity. And it is just very, very difficult to get any kind of confidence going when the moment you start to grow a little bit, you go into load shedding. And that's just to get normal activity levels up. When we're really talking about addressing unemployment, we need to get fixed investment activity going. And for that, you need to be secure in your power supply. You need to have a competitive infrastructure system in the country in order to make sure that all the money you're borrowing today to invest in this country and to build a factory and to put up a shopping center is going to give you the sort of return which makes it viable. So I think those are the main reasons we are not growing, or one of the main reasons, not the only one by any means. And the other thing about the argument between whether you hike interest rates or whether you and focus on inflation or focus on growth is that those two are not mutually exclusive. It's not an either or argument. And the IMF has done a study, I think quite a good study, where they actually look at South Africa and they look at the impact of the hikes in interest rates relative to rising inflation on different income categories. And they prove quite convincingly that the more damaging impact on your lower income group is inflation in the case of South Africa. It is very, very erosive, especially the type of inflation we have at the moment, which consists of food and high food and oil prices, which of course, lower income groups, they consume a far greater portion of their income goes towards your essentials. So fighting inflation, I think, is the right thing to do at this point, and making sure that inflation expectations remain well anchored is the right thing to do.
Well, let's pause on that conversation and take a quick break. And when we come back, we'll unpack some of the other inflation dynamics that we are seeing perhaps in the US and the ECB versus what we're currently seeing in South Africa. So